Hey guys, welcome to this course on volume price analysis. Good to have you guys again. And for those of you who've been watching our other courses, I hope you've been enjoying it. And I'm hoping to bring an immense amount of value to this particular one. And this is actually a course that's really close to my heart because when I started in investing and trading, there wasn't a lot of talk about volume, right? And reality is that it's been used in the stock markets. Volume is used in the commodity markets. In the Forex market, there hasn't been a lot of talk about volume. And even for stock investors and commodity traders, there hasn't been also a lot of talk about volume. There are a lot of statistical stuff out there. And now, of course, everyone is dominated by algorithmic stuff. So there's a lot going on out there. But one thing I would like to say, though, is that volume is the heart of what you would do in financial trading or investing across the board. Now, if you don't understand this, it is going to be very, very challenging with understanding other aspects of trading and investment. And as we go through this course, you're going to see exactly why volume price analysis is so important when we consider investing and trading. All right, so kicking off the first part of the course, all right, so we're going to be able to explore volume in the Forex market. We're going to look at the auction room concept, which is the underpinning concept, and it should make the idea of volume and price as an analysis framework a little bit more understandable and relatable. Right, so we're going to look at reading and understanding volume. So just that basic introductory element. This section is all about introduction. And we're going to start getting deeper and deeper, and we're going to start digging into the concept of volume. By the end of this program, I would expect that you have a very good understanding of volume, and you should see a dramatic change in your trading. Now, if you have been doing incredibly well and you don't know about volume, I should assume that you should get a bit more of an uplift. If you haven't been doing well and you've been really struggling, then this should turn the tide for you. Right, so hopefully you enjoy it, and any questions, guys, just don't hesitate to let me know. All right, so pressing ahead, volume in markets. What is volume? Now, I like to describe volume as the fuel that drives the market. Okay, so price should always rise supported by volume, or if it's falling, it has to fall supported by volume. If you're not seeing that, then we have a fundamental problem. Now, a price move that is not guided by volume should be questioned, right? And that's what I always say. So if you don't see a volume and you see price rising, then you got to start asking some serious questions as to what is happening in this market, how long is this going to go on for, where is this going, if anywhere at all. Volume in FX. Now, there is volume in FX, right? Everyone's going to be like a little bit shocked, but there is volume in FX. And the volume that we relate to when we talk about FX volume is what we call tick volume, but we will come to that. Right now, we want to talk about the idea that there is no central exchange in currency markets, and that's why we have to fall back on tick volume. Now, if we were dealing with the stock market, then of course there is volume is reported, and there's real volume, and you can actually use that in trading. Now, again, because actual volume is unavailable in the currency markets, we need to find the next best thing. Right, so by finding the next best thing, what we're trying to do is we're going to measure the number of time price changes, and that gives us what we call tick volume. So it's basically the amount of bid and ask tick that we get is what eventually amounts to the overall tick volume. And for the guys here, this is obviously the volume bar, and for guys obviously who are familiar with this indicator in the MT4 platforms would easily recognize it. And of course, if you don't use MT4, you would recognize tick volume in other platforms as well. I don't think there's a platform now that doesn't do tick volume. All right, so now let's look at the auction room concept. Right, so the auction room concept is what underpins all aspects of volume trading. Right, now the auction room concept is really, really simple. So again, when we think about Christie's auction, right? It's like an auction room in London where it's really old and it has a lot of history, and a lot of people go there to bid on artwork and other kinds of antiques, right? So what happens in that process is an auctioneer invites bids, and obviously as demand increases, the bids go up, right? So they go higher, and the auctioneer will bid lower or higher depending on whether he's trying to bring demand into the market or not. Now, soon the first bid's in. The auctioneer continues to ask a higher price as more bids come in. So they will normally start out with £1,000 going once, £1,000. Oh, we got 1,500 on this side, £1,500, and then it will keep going, and then it'll go £2,000. Do I see £3,000? Oh yes, £3,000, and eventually, boom, the hammer will go down right at the final hole. Right, so in effect, as bids come in, prices go higher. Right, eventually, of course, bidding is going to cool, because as that auctioneer sets that hammer going, and it's 10,000, then do I get 10,001? Nope. 10,000 going once, 10,000 going twice, and 10,000, boom, 10,000 gone. Right, so sold at 10,000. Right, and obviously anybody's watched an auctioneer's program, which we have a lot of them in the UK. You would probably be aware of this idea of auctions. So that's the whole point about it. It's about inviting bids, and when no more bids are available, the item is sold to the highest bidder. Right, now this gets you thinking in several frameworks. Right, first and foremost, the highest bidder is not the lucky guy. That's the first thing. Right, the truth of the matter is that the highest bidder will never be the lucky guy. Now the other aspect of this is that as bids come in, they illustrate a fact that there's a lot of volume, there's a lot of demand. So that mid-range is where demand is hottest. Right, so when the lower prices, yeah, someone puts their hands up for the lowest bid, but the prices will keep going higher. So the guy who picks up the highest bid is not the lucky guy, because he's paid technically the worst price. And the guy who's probably bidding around about the middle, well, if that ends up being the winning bid, then equally we could say that he paid a good price because he scored as close to the opening bid as possible. So markets kind of work in the same way. So when we see our terminals, we have to get in that framework, or that mental framework, that this is actually an auction process. Now, because also the larger entities that have deeper pockets understand that it's an auction process, they try and conceal their activity to ensure that they get the best prices. So again, imagine if everyone knew why demand was going up all the time, what will happen? There will be no market. Everyone will be like, well, we know what's going to happen. We can actually see this demand happening, and boom, everyone rushes in, and there's no opportunity. So there is that idea that, there has to be a certain degree of concealment or kind of ruse in whatever we're trying to do from a trading point of view, so as not to alert other traders. So larger traders who have a lot more market impact will develop means to deceive us, and that's why we have electronic communication networks, etc. Now, again, equilibrium is the key to every market. All right, so in effect, well, as a large entity, the idea is that to convince others to make the wrong decision, right? And that's the deception in it. It's to kind of trick you into making the wrong decision, so that I then could have a state wherein I could sell whatever asset I'm holding to you, knowing that obviously it's the end of the road. The price is no longer going to go up. So I'm deceiving you by giving you that impression that prices are going to go up. And that's what market makers do. Okay, so they try and deceive you so that you can keep buying at the high prices, and when there's nowhere to go, it goes down, and you will naturally sell to them at the lowest prices because you're panicking. Right, so it's the same thing. So the auction room concept is the beginning of understanding our markets, how they work today. Right, so let's expand on that. So we got the Wall Street auction room, right? The Wall Street auction room is very classic of today's market. So we've all seen a floor, a commodity trading floor, where people are going mad, bid and ask. And this is kind of an auction room, right? So just very similar to Christie's auction room, as we gave an example, there are buyers and sellers on the floor taking offers and making bids on an exchange. Now, the market, like the auctioneer, is gauging demand and supply to determine prices. So the more traders that buy an asset, of course, they tip the demand and supply equation, and the prices go up. So this is a constant process that is happening nowadays over nanoseconds. Now, buyers and sellers on the floor are reading what we call the tape to determine where price will go. So when we talk about the tape here, this is a very kind of old word for the ticker tape, where you see all the shares sold, quantities sold, and it gives you a very detailed description of what's taking place on every transaction. Right, so that's what we call the ticker tape. Now, of course, people who trade stocks are familiar with level 2 quote data, which is exactly that. In currency markets, the version of the ticker tape will be tick volume, right? It's the only version that exists of the ticker tape. Hence, obviously, you can see the correlation there, tick volume, ticker tape, right? So it's the only version of it that you can get, because currency is traded. It's a network of dealers, so it is not centralized. Whilst in many ways some people argue that it is centralized, because I think there's only one company makes 90% of the currency market. So technically speaking, there's a central exchange there. But however, for dealers still have a good degree of control over what prices they charge to their clients. So as a result, we can say it's decentralized, right? However, the stock market and other exchanges are centralized, so they are obligated to report volume of trading, etc., that takes place. Right, now the tape is their view of volume of stock being traded and price. So again, the whole concept is that when we look at Wall Street, when everyone's looking at the tape, or everyone's trying to determine where price is going to go, they're looking at the tape. That is the example there of volume, i.e. versus price. Right, so let's look at modern markets now. So we've had a bit of a progression here from the auction room to Wall Street and today's modern markets, which include algorithmic markets. So we're progressing a little bit from the floor here. Now, the markets are largely about outsmarting your opponent. That is the basic fundamental principle about markets today. It's about competition. And obviously, if we're not competing against one another, then technically speaking, there's no market really happening. So that is the fundamental beginning of markets. Now, the market is also about gauging demand and supply. Okay, so if I'm going to compete effectively, I need to know, is there enough demand there for me to join on the demand side, or should I be selling this asset? Is there enough supply there? So in other words, I need to be able to gauge this efficiently. So I need a tool. I need some way of being able to give myself a good picture of how many traders are invested right now on the buy side versus those invested on the sell side. Larger entities are in a better position to manipulate the order flow. Okay, so if I'm a big entity and I know I control, for example, 5% of the volume of a market, then I know that any trade I make or any purchase I make is going to have a significant impact on the overall market. So I may try to corner the market, or some people will say manipulate the market or the order flow into things going in my favor. And of course, you would hear a lot of traders in the futures market will tell you, guys who've traded on the floor, is that, you know, at a certain time of the day, they will normally try and catch those bids on the upside, and they'll try and force stops to happen. So they'll force weaker traders. So what they would do is they'll put a lot of money just at a reasonable high, enough to push the market and clear the stops out before they actually sell. So this is a manipulation tactic that they know works, because if they do it in synchronicity as a group, they can generate enough volume to force out traders who might not have the same level of market impact. So this is just an example, of course, of that competition and that outsmarting of your opponent. So what can we do as retail traders who might not have the same window or glass as some of these more sophisticated traders? So if we're new to this, what can we do? Well, it's quite simple. We follow the smart money. So we do exactly what it is they do. So obviously we all know about the Warren Buffetts of this world. We follow the smart money. How do we follow the smart money becomes the critical question. Now, tick volume in FX. So these are some of the tools that we're going to bring to bear. So when we're thinking about Forex, let's look at tick volume in Forex. Now, many believe tick volume is 80 to 90% accurate in determining demand and supply. Now, I believe that. I think it is very accurate. From my time, my use of it, I would say it's very accurate. There are other sophisticated ways you can try and determine real volume for FX, but we'll discuss that in the next section as we go. It may be the only tool that we have to gauge demand and supply. So we've got to be aware of this. It might be the only tool that we've got, and there might be no other way to do this, right? Currency is tricky space. There is no other way we can actually get the physical demand and supply volume without assessing tick. Now, tick volume is the equivalent of volume on the tape for the purpose of FX. So as a result, it will be essential. Of course, if we're dealing with commodity markets, or we're dealing with stock markets, then of course it's not as necessary to use tick. Some commodity futures traders will tell you they use tick as well as any contract volume reporting that exists. But again, it's not as important to use the tick, tick volume when dealing with commodities. Now, volume price analysis, the basics. Now, price must always be supported by volume, rising or falling, right? So we discussed that earlier on. So these are some basic tips that you want to bear in mind. Anomalies occur when price shows a small move, but volume is great, or vice versa. So again, we want to assess the movement of price that we have relative to the volume we're getting. And if there is something out of kilter, then we call that an anomaly. And usually an anomaly is an alert sign to say that change is on the horizon. Right. Tick volume is the equivalent of volume on the tape. Right? We cannot forget this. Right? It's the closest we're going to get, so it is the equivalent of volume on the tape. Well, awesome stuff, guys. I hope you've enjoyed this small chapter in the program. Now we have 5 more modules to cover. Hope you enjoy them, and thank you very much indeed. Alright, awesome stuff, guys. Hope you enjoyed the introductory video on volume price analysis. So now we're going to get down to business, right? So in this module, we're going to discuss the types of volume. So we're going to look at climax, low and high volume climaxes, average volume, strong volume, and we may touch on anomalies, but I want to leave that for the third module, which is all going to be about volume versus spread. Okay, so one of the things we're going to do is we're going to first establish what a climax is. Now, and guys, if you haven't seen my course on Wyckoff, then you should check it out after you do this one, because you will be able to transfer your understanding of volume from this one to my Wyckoff course, which is also available on Udemy. So check it out. Anyway, moving along. So first and foremost, I want us to identify climaxes. Now, the most obvious place for a climax to happen is at the top of the market. Okay, so, or at the bottom of the market. So at extremes, right? Now, these extremes are normally determined by that climax. So we don't tend to want to get ahead of ourselves. We kind of want to look for a particular volume baseline. And by that, I mean, if the average volume in the asset is, say, 100,000 shares, then anything, say, about 6, 7, 800,000 shares could be considered a climax, so as long as it's at the top of the market or it's at the bottom of the market. Okay, so that's the first place we tend to look for climax. It's at the extreme tail ends of the asset. Now, there are occasions where we may see climaxes in much lower time frames, and those will be reflected probably at a midpoint of price development, but we'll look at that example. So I'm going to take 2 different examples here. This is an example of a stock, Apple, which is a different asset, and we're also going to look at $MXN, which is dollar versus peso. So this is a currency, right? So we're going to look at these 2 different examples and see what they reflect, or do we get a different outcome when we assess the concept of climax here. So this is a climax. Okay, so we can see this extreme volume trading here. That's 118 million shares that they traded in Apple, right? And we can see the price depressed, and we had that top. Now, Apple had been rising significantly for some time, so we'd have to assume that this was a climax. Right, now, I'm not going to talk about this one here yet, because this is a completely different scenario, and I'm actually going to discuss that in relation to strong volume. Right, so if you're already looking back and saying, oh, wait, there's that one there too, what does that mean? Then don't worry, guys, I'm going to come to that. So we're going to look at, so this is Apple, so we got extreme price flow, and we got high volume climax. Right, now, again, another example. We have extreme volume here, in this case, 162 million shares, way above average. Bearing in mind the average at this point was 68 million shares, so it's quite high, right? So again, we see strong bullish candle, lots of tail action, and this is a climax, right? So that is telling us that in the future, all things being equal, we should see a significant rise in the price of the stock, okay? Because this is telling us the market is climaxed, and this market has been short for a little while, for a few days, and then we post this amount of volume, so it's quite extreme. Again, this is an example of a climax, right? So what I want everyone to do is understand what a climax is. A climax is technically high volume, and this is independent of spread size now, in terms, and we'll discuss spread versus volume in a minute, but this is independent of that, if we see extremely high volume at the top or the bottom of the market, there is a 90% chance that that volume is a climax, regardless of whether it's on a bullish candle or a bearish candle. This is so important, right? It doesn't mean that the market closed lower and it's the bottom of the market and you get high volume doesn't mean we're going to continue. In some cases, it actually means that the market is going to reverse. Right, so we have to be very aware of where it is taking place. This is the crucial lesson a lot of traders will forget, and they'll make mistakes. Is we want to assess how long is this market been up before we saw that high volume, which is climatic. How long has it been down before we saw that high volume, which is climatic? Key question to ask. If you don't ask this question, you will get it wrong. Right, really simple, right? So it's really important, right? So you can see why I believe this is to be a climax, and you can see why I thought this was a climax. So this is probably one of the easiest steps you're going to take in trading, and you're probably going to walk away thinking, yes, I've got this, I'm going to do this now every time, I'm going to make a ton of money. But the truth of the matter is that this is all it's part of a wheel, right? So you get in one portion of the wheel, and when you've got the whole wheel, then you can step away. Right, so let's move forward. So that's describing climaxes. Now this is a high volume climax, right? So this is what typically we describe as a high volume climax. Right, now we're going to observe what we call a low volume climax, and I'm going to use a currency to do that, and we're going to use the peso here. So now this up here is an example of a low volume climax, and it's a climax because it is actually occurring fairly at this point in time. You could have adjudged this to be the bottom of the market because the peso had been falling for some time. However, what's interesting about this is that the volume itself is not very high, and we have a lot of tail action at the top. So this is very similar to when we look at anomalies, right? But and that's why I said we're probably going to touch on anomalies, but it's very similar to an anomaly. But this, interestingly enough, is a climax, probably from a much smaller time frame. Now, because we're dealing with currency, this would actually be a very large extended move in a very volatile asset of the peso. So this drew in some climatic behavior, and then we see a tiny volume. This is an anomaly for sure. Something isn't quite right about this. And this would alert you. So if you've been short this market, I would start looking to cover my trade, because whilst it's possible we may get further decline in the peso, 10 chances to 1 in the future, we are probably going to see the peso reversing. So it would have been a good time to start considering whether you should have stayed in the short position or not. So this is an example of a very odd type of climax that's associated with anomalies, right? And on this occasion, we have declining volume at the base of the market. So there is absolutely no buying taking place at the base of the market, and there was no climatic action. We call this a low volume climax because the market is fully exhausted, and we can determine that by the drop in volume. And actually, when we start discussing volume v price, so again, I don't want to get ahead of myself, I guess we will it will add some more clarity to low climax volumes, right? So this is probably the only time we're going to touch on anomalies and low climax volume in relation to volume versus price. Okay, so we got a price declining, volume falling off, a lot of weakness in the market, and this is what we call a low volume climax as well. So we got two examples there of a low volume climax. And again, using a currency, we have another example here of a high volume climax, right? So again, that's just that bar there. So as you can see, doesn't matter that we were seeing this on a bullish bar. This market had been long for a while, and we showed that volume, and the next day we broke down. So it was a very easy short to make, and obviously this market declined continuously. And if we walk ourselves more recently, we're going to draw ourselves into another concept, which I'm going to explore, and that's strong volume, right? So this is what we call high volume, and again, this is in relation to volume versus spread, and we'll discuss this in a little bit more detail. But this is what we call high volume accompanied by strong price action. Okay, so this is what we would consider really strong volume, because where it's occurring, two, what kind of spread it's generating in relation to open and close prices. Okay, so we'll discuss this a little bit more in detail, but it's a good idea to get a handle on what strong volume looks like relative to climatic volume, because they're quite different, and everything is to do with the spread, the difference between open and close, which we're actually going to discuss in the very next module. Right, so we've touched on briefly anomalies, we've touched on strong volume, and of course the obvious is average volume, which tends to mimic just regular volume. Right, so average volume over time. So not too much of a concern, because average volume will observe continuously. It's volume below average and above average that's most important to us, but average volume will continue to observe. So these are the different types of volume that you're going to come across. And we can see that there's a linkage here between anomalies and other aspects of climatic volume, and this linkage will mimic itself as we go through different modules, because you'll keep seeing us relate falling volume, for example, to falling price, but also taking into account that then maybe no climaxes, etc. So there will be a lot of sort of interdisciplinary play as we move through the different modules. So anyway, hope you guys have enjoyed this section. Any questions, let me know, and going forward, I see you all at the next module. Alright, hi guys. So back to the course, and we're now on the third module, which is volume versus spread. Now what I'm going to do on this module is I'm going to kind of give you guys an understanding of how to interpret volume in relation to the candlestick spread or bar chart spread or any other form of analysis that we're looking at, that type of spread. Alright, so it doesn't matter if we're looking at a bar chart, we're looking at a candlestick, or we're looking at a point and figure chart, or we're looking at a time price opportunity chart. We will analyze volume versus spread in the exact same context. Okay, so just so we understand this. So I'm going to show you some of the nuances that you're going to come across when you start playing and trying to analyze volume. What's an anomaly? What's good volume versus good spread? And the thing you've got to understand about volume price analysis is that you have to form baselines. So it may take you about 2 or 3 days to collect all the volume data on the asset. Now, like MT4, for example, you can export this into a spreadsheet and see all the volume that is traded in real-time numbers. So you can collect all the tick volume and then determine what is average tick, what is high tick, what is low tick. So it's the same with any other platform. Obviously, more interactive platforms like TradingView that I'm using now already gives you an average volume over time, so you can form a decent enough baseline in terms of what is high and what is average, right? But you'll find that by analyzing individual volume versus spread, you build a better picture of your marketplace. All right, so let's start with we're going to look at the first part. So we're going to start with the bottom of the market and work our way up. Right, so you can see here at this point we got incredibly high volume. So in terms of contracts, we're looking at about 115,000.42 in terms of tick volume on contracts. And in this case, obviously, this is using a CFD, right? So this is all tick. The broker's Oranda. So as a result, this wouldn't be similar to exchange or contracts volume. So I'm actually looking at a CFD. So I'm going to call it tick volume, right? So it's about 115,000 on tick, right? But if we look at the actual spread, it was a bearish move. It was on a relative top, right, which implies that the market is going to fall. We can see that it was supported. However, we know that there was a degree of absorption here. The reason being is that the volume is pretty high relative to the spread. Now, if we look at a similar spread, which will be this one here, and we look at the volume, now this seems to be like a more reasonable reflection of the volume versus the spread, right? And I can see that because I can average it out to every other one that I'm seeing, and I'm getting about the same. So I can see that the sellers were dominant on this day, right? But they were also being absorbed by buyers. So there were buyers who were taking advantage of this period and absorbing the volume as the market went down. So I do know that there will be a kind of a drop, but I'm also aware that the drop might not be too significant, right? And when we start thinking about aggregating volume, it matters a lot more, all right? But we're not doing that right now. Right now, we're just looking at the individual spreads versus volume, right? So this becomes a crucial point for me. So I'm seeing high volume, somewhat limited spread. So it's kind of an anomaly, right? So the market's going to decline but I have to be cautious. And that's what that's telling me. So anomalies tell you caution. So I mentioned that earlier, that when we're thinking about anomalies, we're thinking about them in terms of caution. Right? And as you can see, we're touching on the concept of anomalies at the same time we're looking at volume versus spread. Right? So as the market continues to decline, we post in what seems to be reasonable volume in terms of volume. So we're talking about 93,000 versus tick, and reasonable spread. Right? So I'm pretty happy that seeing that we got a solid open close, very little tail end, pretty decent volume supporting it, that there will be some continuation in this market. So again, this will be a nice price level to buy on perhaps the close or on any retracements, and we should get a fairly good few days, maybe a good week of that upward price movement. Okay, and obviously this is followed. In fact, we might even get longer. And what we'll try and do most of the time is assess how far this market could travel, seeing that we're seeing this sign of strength here. And bearing in mind as well that there was a degree of absorption here that we were fairly certain about because of the spread, that it's quite possible that buyers will also take in this price as well. So we're seeing now what would look like an accumulation. In fact, if we look at this candle right next to it, this is even more of an anomaly because we have a very tight spread, pretty high volume. So it means that the sellers are largely being absorbed, because we have to put this to reason that if all this volume was piling into this movement here, then we should have a slightly wider spread and something more equal. But in fact, the spread is a little bit tight. So obviously seeing buyers return and create some strength on volume, it's a pretty good run. In fact, this whole pattern here is like an engulfing pattern for candlestick traders. So they might actually think, oh great, this is the market to go long. But what we're looking for as volume traders is we're looking for the volume to support the price move. And that's what we're getting here. So it's good volume, good spread. So this is a really good buy. And judging we've seen anomalies in the past, it's a very good chance this market was going to go up. Right, so again, as market progresses, we look a little bit more to the top side, and then we can actually say that in this occasion here, there's a really tight spread. Like there's nothing going on here, but look at the volume trading into that spread. It's pretty high. Right, so again, this is another anomaly. So it's a possible top. Right, we're not going to call this a top yet. We don't know. We have to see what the market does next. Obviously, we see that as we develop, there's a bit of a breakdown. Right, so it seems like the suppliers were involved. However, judging from the volume that we've seen, the supply volume coming afterwards, if you look at the spread and you look at the volume, there wasn't a lot there. It was pretty low. So this is usually in the low volume territory, and we're pushing a little bit of spread. So I get a little bit concerned. I think the spread is a bit overemphasized here, and it could mean that the market is going to rebound. However, could be a possible top, and that also tells me that traders may well be trying to exit their positions before a much bigger decline. Right, and we're looking at a chart of crude oil right now, and this is actually playing into a very modern narrative, like what's going on right now. So this is the other aspects that we got to consider is where it's taking place. So I mentioned that in the last portion of the course, that where this is happening is very crucial. Okay, so again, we have a possible top. We're not sure, but the market is probably going to sell off. And of course, it did break the top of this, break the highs to this volume. So again, in the future, it showed a degree of balance. So not surprised to see it running away. So it's really important to note what was taking place here, though, is that it's possibly traders exiting, and this market is largely being cooked up to the highs, and it's always something to be aware of. Right, so as we push further into the narrative, we actually see that, again, we see another anomaly. So a huge amount of volume here. Again, it's a possible market top because we're seeing an anomaly. But in this case, we see that the supply comes in. It's pretty heavy, but then we see the spread is not too big either. So there's not a lot of support here, but it does tell us that market is probably going to drop for a few more days. But in my opinion, the volume is too much. So it tells me that some of the sellers are being absorbed. So it's very similar to what we discussed here. So again, I would be a lot more in alert. And then we have a climax, bizarrely enough. So after all that activity, we get a very big climax at the base with a tail, like very narrow spread, pretty big volume. Right? In fact, it's probably the highest. It's 212,000 in tick contracts. This is crazy. So I then start anticipating that, well, if the sellers are being absorbed by buyers, then the prices are probably going to go higher. So this is actually a really good buying opportunity at this point. So despite closing lower on the day and showing a very bearish attitude, it tells me that this market is probably climatic, which means that the buyers are not done with it yet. So the sellers were absorbed. All right, so that's another good example. And of course, as you look now, oil is trading $67 a barrel. But again, we should be quite aware of what's taking place at this point in time. You see right at this point as well, there's another anomaly here. Sellers being squeezed, and we got a high volume. Again, another great buying opportunity. So it tells me there's a lot of demand still invested in these areas. Right, so again, as we go, we can see that very high volume, slightly narrow spread. So now the buyers are being absorbed. Right, we look at this one actually here, right here, this one here, pretty good volume, good spread. Right, so this is actually really good mirror here to tell me that this market was going to keep pushing up. So it's a lot of good strength trading here. But again, we're seeing that met almost immediately by climatic behavior. So it's telling me that this market is probably nearing a top, and these are probably traders exiting their positions rather than any real strength. But we are seeing some buying going on, so I'm assuming that we're probably going to start finding our top at some point, and we're going to end up with a major climax. But at this point in time, we have to see what's going on. So again, we are looking for the points where we see strength to get involved in. We're not looking at the points where we're seeing climaxes. Anytime we see anomalies or prices being depressed, we want to immediately express a certain degree of caution. So it's the ability to move quickly and take advantage of very sharp moves. Short term tends to govern the concept of using volume versus spread, because it allows me to swing trade quite easily, get into a market when it's hot and get out when it's not so hot. Right, so that is a breakdown here of volume versus spread. So again, if you're looking at analyzing volume versus spread, these are the key ways that you do it. You look mainly for anomalies, and you look mainly to see if the volume matches the spread, and that's all you're looking for. If I start seeing anomalies, I want to be very cautious, because anomalies are probably going to alerts to the fact that the market is probably on a changing course. It might not happen right now, but the process is underway. So prices may break certain levels and move a lot higher, in which case it's perfect. You can jump on the bandwagon if we're breaking certain levels, but at the same time, we want to be very aware that some kind of exit is taking place, considering that this market has been traveling long for quite a while. Right, and when we start seeing again huge climaxes here, they alert us to the fact that these markets may well get really strong on the buy side. So we become a little bit more cautious in terms of how we do things going forward. All right, so that's an example there, obviously using crude oil. So again, I just wanted to highlight to you guys, it doesn't matter what market you're trading, whether you're trading a commodity, you're trading a currency, or you're trading a stock. We've been able to see in all those markets the presence of anomalies, climaxes, and what they meant for our bottom line. Okay, and when we start looking at short-term strategy and long-term strategy further down in the program, you'll get to see how we can use this to devastating effect, and we can make ourselves a ton of return that to most investors who are not in the know, it's going to seem like unrealistic, not very real. But the truth of the matter is that if you employ these ideas in a very constructive manner, we can do pretty well with it. So again, you know, it's just bearing in mind that you are trying to create an analysis framework, and you have to be patient the way you go about it. And you can't be like, oh, I'm going to make quick gains tomorrow or something like that. No, you want to be still meticulous, and you really want to think about it, and you want to analyze your risk and decide where you go. All right, so going forward, guys, hope you enjoyed this part of the course. Any questions, let me know, and I look forward to seeing you on the next section. Alright, hi guys, welcome to this section of the course. So we're going to be looking at volume versus price. Right, so this section is going to look primarily at volume versus price. Now in the last section we discussed volume versus spread, so i.e. open and close price spread, or low to high, i.e. price spread. Now we're going to look particularly at grouping or aggregating the volume and sort of comparing that to progressive rises or progressive falls in price. Now this is really, really important. Now we've looked a lot at crude oil, so we're going to flip this over a little bit, and we're going to take a look at the currencies a bit more as well, so we can get a a very good reflection in terms of what's the best way to sort of approach this. So in effect, I'm going to walk you through the different elements to consider when looking at aggregating the volume, and this should give you a very good picture, i.e. of how to look at an asset from a broader sort of macro perspective. Now, a lot of traders can get quite fixated on smaller price movements, but it becomes really essential to be able to look at a market more objectively over a longer time frame. Okay, so that's all part of the development process that we're trying to achieve. All right, so moving forward, now when we think about price, right, one thing that we have to get into the back of our minds is that when we think about price, and if we go back, so those of you who haven't seen my Wyckoff course, then check it out. Okay, really important, because when we look at Wyckoff 3 laws, okay, and we talk about effort versus result, right, and we think about price in relation to volume. So if there's a strong price move, there has to be the volume to back it up. Otherwise, we have to start looking at it from a completely different perspective. All right, so there are a couple of ways we're going to group volume. We're going to group volume in terms of rising volume, rising price. Okay, now rising volume, rising price normally indicates a very strong market. Okay, so if I see the volume rising over time, this is a daily chart of dollar MXN. If I see the volume picking up over time, so each day brings me progressively higher volume, and even if we don't say each day, but let's say every couple of days, I can see that the volume is progressively increasing and the price is progressively increasing. Now, don't forget, I'll also be doing my volume spread analysis. Okay, at the same time I'm doing my volume price analysis. All right, so I'm actually doing both in tandem. So I'm looking at the price pickup and the volume pickup, right? And I'm also looking at the spread, which is giving me a good idea when is a good time to enter the market. Okay, so if you revert back to the previous content on volume spread analysis, then you combine that with what you're seeing here now, then you have a very good approach to sort of deciding whether you want to be in this market or not. Right, so as you can see, progressively the price is rising and rising and rising, right? And then you can see as we reach the top end, we start to see a lot of climatic volume. So the volume peaks in very strong movement. So we see that here where we got a very restricted spread, very high price, right? So it tells me that to some degree these sellers were being absorbed, and that led to a lot of pushing upwards, even more climatic activity right here. So we have even higher volume, and that presses the market down, and we get hit by another climax around about the base. So the reality of what's taking place here at this point in time is that we're seeing a lot of volume activity as we near the top of the market, and the reason for that is actually really simple, and that's because a lot of traders are now liquidating, or in effect getting out of their relevant positions, right? So they've been long for a while, and as we reach this top, we're seeing a lot of liquidation, and that's causing a lot of pressure. Now at the same time, we're seeing buyers absorb that liquidation from the much more smarter money, we should say, and then obviously we see the market rising again as a result of that absorption. But something quite interesting to note, as this market rises, you can see that the volume was progressively declining. We were just having a lot more climatic activity along the way. So this is very typical of the final runs of any market, is that we start to see a lot of heavy volume trading. It's very similar to what's going on with crude oil right now. So guys who are looking at crude oil, that is a really good example to sort of put to the horizon, right? So going forward, you can see that, and the other context we're going to look at is falling price and falling price, i.e. and rising volume, I should say. I should actually edit this text. So we have falling price, all right, for the purpose of being proper, getting everything correct, right? So we have falling price, rising volume. Now this also means it's a strong market just in the opposite direction. So it's a strong seller's market. Some traders get a little bit confused at this point because we're talking about rising volume and falling price, and here we're talking about rising volume and rising price. Now these are both strong markets. This is a strong bull market, this is a strong bear market. Okay, and we can see that the volume is rising quite steadily as the price falls, which means that this is actually genuinely a good move to back. So whenever we start seeing a lot of climatic activity, which becomes quite evident here on these very restricted bull candles with heavy tails, and we get a breakdown, we know that this is actually a solid move we can follow for the next couple of days, and we can expect a pretty decent return into support levels or whatever you use generally for targeting. Right, so you can see there was that bit of progression there, and obviously we start to consolidate. And notice as we reach the end of the consolidation, you can see that price volume starts to fall as price starts to fall. Now this is typically a weak market, okay? So if this starts to happen despite the price move, just expect that a big reversal is coming. And obviously, as you can see, we're showing a lot of strength at this point. So this is what we call a very strong volume, strong spread. This is a very good move. And obviously people who are buying this move, even at market close, have already realized quite a significant gain. And if we go forward into that spread analysis, you can see as the market was rising, the price is falling slightly, which suggests that the buyers are weakening. And as this happens, we should see more or less a pushback against the buyers as they lose interest on the way to the top. So these are the kind of things that you kind of pick up on, is that you can see where strength is happening, you can see where weakness is happening overall, and then you can start to shape, i.e. the future, in terms of where things are going. So this is actually a very good example of how we relate, or we aggregate that volume relative to price, and it's actually relevant. So it doesn't matter what time frame that we're looking at, we should relatively get the same effect. All right, so to kind of bring in another quite unusual example, all right, so here we see a very, very low volume, like relatively declining at some point. So again, in line with our narrative, right? So we got volume is falling, price is falling. So we can see that from this point, we get a bit of a decline, but also volume's declining, and it keeps declining aggressively even on the return. Now this is normally sort of a low volume climax. This is a point where all volume exits the market, really because we're trading in an area that is quite low. It is not much of interest. So if we see volume that is completely flat across the board, like just literally comes from a point where volume is like this, as we sort of reach in the end of the market, and it enters a phase wherein actually for a long progressive period of time it's like this, then this is a danger sign that actually the market is at an all-time low, all-time bottom, and most likely will have a new trend developing from these kind of areas. So again, for those of you guys who've checked out my Wyckoff course, would know that this is the point where the terminal shakeouts happen. This is the point where we look and all volume is dried up, all interest in the short and long side doesn't exist, and it's a perfect place for the smarter money to start accumulating the asset. Right, so again, these are like usually long time lows. So a lot of the market is completely exhausted, completely sold out. They've been selling for days on end. People who've been losing money have finally given up the ghost, and the market now has lost both buying and selling interest because people are still reeling from the initial decline. So if you're in a long position, if you've been holding it too long, which is very common with bigger firms or bigger bigger sort of hedge funds, they tend to hold their positions for a long period of time. And even though we say this is dumb money coming down on the last run, but the truth of the matter is these guys, we call them dumb money, but they are dumb money with a lot of money, right? So they're also playing a major role. So this decline that we're seeing here, weakening along with price, is really perhaps the last of the money now just clearing the table. And at these lows, we don't expect to see much interest, and it's from these lows we start to see volume peak as we enter a new trend. So these lows actually are very significant to kind of look out for, especially when we're dealing with this in relation to assets. Now you would find that if we're looking at assets like stocks, for example, we don't necessarily always see the same kind of behavior, and this is something to kind of really take note of. Now occasionally we could see attitudes of lower volume as price rises, but really with the equity markets we are really concerned with the volume spread analysis of things, so rather than the volume price analysis, because what you would find is in a very strong bull market, volume tends to be lower because everyone with stocks, everyone invests at the bottom and they have less incentive to buy the middle. So if I'm a value investor, I'm focused on buying the stock at the cheapest possible price, and because it's limited in supply, we don't have the same level of liquidity as in currencies. There's more action at the tops and bottoms of the stock market, which means that volume is strongest there. So if you're looking at stocks, and the way stocks are traded as well is a little bit different from the way currencies and some other assets are traded. So if we're looking at stocks, what we want to focus on primarily is these spikes. Okay, so really it's the volume spread analysis of things we want to get our eye on. So again, if we see a hell of a lot of volume trading into shares at the bottom of the market, 10 chances to 1 a reversal is on the way. So assessing a stock technically is actually a little bit different from assessing a currency from a technical point of view. But for this section of the course, it was handy to use currency because there's a hell of a lot of liquidity, and that allows us to kind of focus a lot more on the volume price analysis of things, and we can sort of step away from the volume spread analysis. But remember, guys, we have to be doing both these guys in tandem. And when we look at the practical application of this in a real-time market, I will show you guys the best way to analyze it. Now, we're not always going to be right, guys. Don't want anyone thinking this is a magic bullet, but it will certainly improve your trading in the long term. It will improve the way you deal with the market and assess the market from whatever you've been doing in the past. Right, so hopefully that makes a lot of sense, and we can now press ahead relatively to looking at another aspect of the program. Any question, guys, feel free to let me know. Alright, hi guys. So welcome to this section of the course. We're going to be looking today at short-term trading strategy with volume price analysis. Now, what's really important about this is that you guys look at how we would do it. Okay, I don't want anyone to be focused at the moment on right or wrong, or whether you're going to get it right or you're going to get it wrong. I want you to focus on the best way to do it. All right, so we're going to start with initially good practice, and then we can sort of take things from there. Now, the cool thing is that with TradingView, they've got this new, and I'm going to start with oil, by the way, but with TradingView, they've got this new replay setup, which is really great for doing this kind of real-time type tuition, right? Which is a bit difficult to do, especially if you are, trying to look at a live market. I might as well just sit here and trade for the entire course, right? But truth be told, it's really easy to sort of have a look back, but also take away the future for a second. Take away everything that's happened and just hit an asset head on and look at it the way you would have looked at it when you were dealing with it or you were trying to trade it. Right. So again, that brings me back to crude oil. So this is taking us back to quite historically, and we can get a chance. I think we're looking here at the 27th of March, if I'm not mistaken. I think it's the 27th of March. Yeah, so this gives us an opportunity to see how the market played out in the future, and it's a very, very good opportunity to kind of use some of the skills that we've just acquired from learning about volume spread analysis, volume price analysis as a subject matter, and actually putting that into real terms. Now, remember, guys, we're not going to forget that this is all about auction market mechanics, right? So it's the principle of an auction. Our markets are based on the auction market principles, so we kind of have to sort of stick to those principles. All right, so let's start from the beginning. One of the first things you're going to make, this is actually a short-term trading strategy. So we're looking at a 1 hour chart of West Texas oil. All right, so West Texas Intermediate WTI crude. All right, so what we're actually doing is taking a look now at what's taking place here. Now, this is after hours. So what tends to happen is we get a lot of volume trading during the day, which is normal. So within the most liquid sessions of the day, the volume peaks, and obviously within the most non-liquid sessions of the day, the volume declines. And on odd occasions, you would see really strong volumes in non-liquid sessions of the day, which are also kind of warning signs of a possible future. So this is all when we're trading short term. So whether you're a scalper, whether you are a kind of more start of the day trader to end of the day trader, or you are a session trader, however you come at the market, okay, it doesn't matter. What we're going to look at is some of the core principles right now surrounding volume in these markets. Okay, so at this point in time wise, we're looking at 5-6 o'clock GMT, so it's quite late. And as we progress into those wee hours, 8, 9, 10 o'clock, 11, 12, 1, 2, as most of Europe goes to sleep, we see that the Asia session is quite weak, and even though there's volume participating, it's actually quite small. Right, so I'm going to hit the play button, right, and we're going to take some factors into consideration. Now, but before we do that, basing on our concept or understanding of volume price analysis, what we can first identify, which took place at 3 o'clock in the afternoon, and this would usually be when all that US data is probably hitting the fence, or it could be crude oil inventories, which tends to like 3 o'clock for news, right? We're gonna put a bit of a marker on this because it's quite significant, okay? And we can see that we had relatively high volume for the day. If we look historically, we can see that there was a lot of restriction here. There was a lot of supply absorption, so this might not have been a good move to follow down because we got a really tight spread, extreme volume. It looks like the sellers are being absorbed, so there's a lot of concern here. If we look back a little bit earlier in the morning, it's about 0100. You know, we see a lot of supply trading in, a bit of tail action. Again, we can see that the market is relatively restricted, right? So that offers up some challenges. So we got a lot of supply pressure, but the market's been held back a little bit. But it may well be implying that the sellers are actually really regaining at this time of the day because it's really early and we're seeing a strong open to close. We just know that there has been some buying involved. So this is something that we could time, and it does look like a pretty good move, at least for after hours in the Asia session. Right, as we sort of build into the European session, we start to see that things start to cool off a little bit. We do see a little bit of volume seeping in on the supply side, but it doesn't look like much at all. So it does just implies that, you know what, we're seeing a bit more volume now at the bottom of the market at the end of the session. Could be some short covering, right? So despite the spread, and we're getting a very good mirror here, there could be some potential challenges, right? So we're very conscious about where the volume is taking place also. And when we're looking at short-term trading strategies, we're looking at time of the day the volume is taking place. Because remember, if this market had been selling off from about 1 o'clock in the morning, it can't keep selling off forever. Otherwise, we're going to get a bloodbath, right? So by 7 o'clock in the morning into a new session, you would expect that traders want a better price, and they may not continue to sell this market. But it's a very strong precursor because at this time of the morning, this much volume with this much price fall, this could actually be a much longer term decline. Right, so let's press forward now into the future. So I'm going to hit the play button, and you can see how that volume develops through the day. Right, so we're going to hit a bit of a pause here at this point. Right, so you can actually see now that we started to pick up. We had a pretty reasonably strong volume, a lot of tail action at this point. So again, I'll be very dubious about this because again, we'd like to see a clean spread. And judging by the way things have progressed, again, we did have a climax here, which was really strong volume. So buying here again might be a bit more challenging. So again, we had a powerful volume here, and as we went to the top, we can see that volume declining a little bit after a very sort of dull intermediary session. So this very much could mean that the buyers here are now exiting the stage at the highs, right? So we're putting in a few more concepts at this point, right? So at this stage, it might be the market's about to turn around, and we might want to give that a bit of a wait and then make a decision then. Obviously, we chuck in a really strong supply at this point. Looks like there's some tail action here as we enter the lows. Could mean the market's going to get tied up a little bit, but there's definitely a lot of supply there. In fact, when we look at the next candle, yeah, I mean, it looks like really things are tightening up. So we're seeing more and more supply coming in, but we have a really tight spread at this point. So we could be looking at a breakout market. Okay, so let's have a look. Right, so again, you see there's a bit of struggle there at this point, right? So we don't go down immediately. Volume started to fall off, so we have to start getting a little bit concerned. We could be met ultimately by a strong reversal, but let's see if we can take out the lows where this volume's quite high. And we do, right? So that tells us that it's a pretty decent move. So if we now combine our analysis going back, so we had a 1 o'clock in the morning complete attack, right? Market drops several points, right? We get some climatic activity. Buyers run it to the top. So this was actually a really good trading opportunity to buy the market at 65 and then sell it at 66.25. Okay, so it was a really good opportunity. And even if you missed that, right, and you caught the sort of bottom end of it, which was about 65.34, it's still a really good turnaround if you're selling at about 66, right? So it's a really good turnaround, right? Remember, oil is a big contract, so it's quite decent, right? So again, that was a trading opportunity, and once we broke back, we got a bit more concerned because obviously there was a lot of supply here, and it was a good opportunity as well to consider a short position because, as you can see, the volume was back in the spread. We were a little bit concerned about the tail, so we probably needed to see a break, which we started to get at this point. So this would open up a really good short opportunity. And as we go down, we can see that supply there piling in via spread. But something interesting also is happening we can see that volume tapering off. So we know that that market is going to cool pretty soon. So let's keep pushing it. So we still get a bit more of a drop, right? And obviously, as you can see, the market cools off anyway as we get into after hours, right? So again, now we're a bit more steady, right? Some more supply coming in there. So again, but you can see that obviously the market is losing a little bit pace after hours. And as we drive into a new day at 7 o'clock, we're showing a bit of a tight end spread, slightly higher volume at the base. So we can see that tail. So we know that, okay, this market may have a bit of a spring in it. But again, what we're looking for is the more extreme volume, right? So again, hold that for a second. Let's do that. Right, good. So here we see big spike, right? So it does look like a climax, but we got two tails on either side, right? Very tight spread on the bull side. Now, it could mean that this market is about ready to break. So in my opinion, it will be the guys who've been short here are now covering their shorts. So whatever is taking place here now is just a little bit more extremity, right? So it's the last level. So we can see again, as we hit the bottom, I would definitely want to be prepared to be a buyer at this stage. But as we hit the bottom, we can see that obviously that climaxing is really happening. So that's the importance of noting where these things are taking place, because what we're getting here is a lot of climax at the base of the market, and we want to be really conscious of this, because again, it means that this market may not keep rolling lower. Obviously, we're seeing a lot of supply here now, and obviously, again, we want to be very conscious that this market may well be absorbed for higher prices. Right, so let's see how things keep playing out. Right, again, so we have now a complete bullish reaction. We're probably going to look at these highs again at some point, trade around here for a little bit. But again, you can see us flatten out after hours, obviously after that return. So again, let's see how things progress through the subsequent days. So you can just see how that market cools there, and then, oh, there we go. Just pause for a second. So we can see here now, obviously, the buyers now taking the bait. So we can see there's a bit of tail end here, slightly higher close relative to the highs, and it's in a really good place. We're taking the lows here at this point. So again, this is really strong for me, very strong kind of move. Slightly tighter spread relative to volume, but there's a lot of underside tail action. So for me, this is really good demand volume wise, and it's a market that I'll definitely wanted to buy. So again, if I'm a buy at 64.73, let's see what this thing does in the near future. Right, so again, it's a bit of a struggle. I would have expected a bit more continuation. We're flattening out a little bit, so I would be wanting to take my profits, to be fair. I think it's been quite eventful at this point, but I'll be really watching this market now quite closely. So it's a bit more, so you can see that volume taper off, and there you go, so it breaks down. So again, this is the kind of stuff that I'm saying. So again, we had a bit more climatic activity here. The market pushes a little bit higher, but then obviously things change. We go down again. Now, if you ask me, judging by the supply guiding this, so look at how everything develops. So we've got a tiny volume here, overemphasized spread. Supply definitely joins this. This was a really good spread to volume ratio. I really like that. We had a bit of volume, bit of spread, very clean. Definitely a short at the end of this for sure. So that would have been a selling move. But then as we go down, you can see that volume gets a little bit uneven and starts to tighten out. So that tells me that we're probably nearing some kind of a bottom. So let's see how things play out. Right, so again, we're still pushing, pushing in some more lows. But as you can see, the volume's now dissipating. Right, the buyers are not really. We're just seeing a bit of a cooling sensation now. So at any moment, I suggest we're going to probably find some strength, and we're going to start picking up. Again, you see we've risen slightly, and you can see those buyers getting investment there. So there you just pause that for a second there. So you can see those buyers getting involved. A lot of strength playing out at this point. Very sort of tight spreading happening, right? So again, it feels like we're kind of bracing here for maybe one more decline, and then we're probably going to pick up, right? But again, so you can see those the suppliers respond to absorb those buyers. And again, you just wait for that one and see if the sellers hold. Right, so we're seeing a lot of weakness now on the upside, lots of weakness. So that's telling me that we're probably going to break down again. Not a lot of potential at this stage. We need to see that. So we're in after hours now, and again we continue to break down. So again, we can see that excessive supply coming in. So now we should be nearing the bottom at this stage. Yep, there we go. So just like that pause there, we get a big response. There's really strong sentiment there. I would definitely want to be long. Perfect buying opportunity at this point, right? Market's all-time low. We've responded to some of the more short-term opportunities, and here are some of the big ones that we can play with. So again, wanting to get long on that, and we start pushing up a bit. Bit restricted though. I'd like to see a bit more of a flow, but I'm pretty sure at this point we're probably going to rise anyway. So at least up to the highs. Yeah, so let's see if we can take out these highs. Again, we're in after hours, so this market is weakening out a little bit. So expect probably a retracement. So we're getting a bit of steady supply here, and then we're up again. So now we can see obviously that the market really climaxed up there, really hit a window, and that would probably been a really good exit, right? So it's a nice little push there to the upside. So again, you can see, but as you can see, the reaction at the top now is becoming less and less interesting. We're seeing a little bit more buyer investment. So sellers are still trying to absorb it, but for the most part, things are holding on. Right, so again, we want to watch that space, just see how the market reacts. So we're seeing overemphasized selling, probably going to be a rebound at some point. We're going to end up a lot higher. So again, we're into those after hours, so we're seeing some more strength coming in. So now we can see that the buyers are showing a little bit more intent, right? Even though the sellers are fighting back pretty hard. But whoops, there again. So we get I should have paused this. So we get a bit more supply, right? So we're not always going to be right. At the same time, we're seeing a little bit more activity. We're seeing what looks, again, we're always analyzing that spread. You can see we've got a bit of a high spread here, so challenging any buy positions we're trying to make. And obviously, we break down strong supply, strong spread. This is the kind of stuff we want to be going at the back end of. So as a trader, sometimes you've got to isolate what you want to trade with. I have some clients that like to trade only these kind of spreads. So they see solid volume, solid spread, and they buy off the back of that, right? So they can get some momentum. Same with these. They're analyzing the spread and they short off these. Again, this would have been another great short, but they would not look, for example, for climaxes because they're not really sure how the market is going to respond to climaxes. Are those levels going to get retested? And again, if you look at my Wyckoff course, it tells you the very good reasons why those high volume areas get retested, right? So again, that's another example. So I'm trying to run everything in real time so we can get a feel for it in terms of how we'll be seeing it on our charts as volume starts to develop. Remember, this is loading each bar, so you'd have a lot more time to react. Obviously, again, you see that volume is dissipating after hours. So again, as we sort of move into more liquid sessions, the intent starts to get felt, and all of a sudden we get a bit of a spring, right? So again, you can see that volume there back in that initial move, and then obviously we're cooling off again. So it's just getting that early expression in of what you want to do. So again, you can see that this move here was actually really legit, strong spread, real good fight back, middle of the park, and we had a nice rise in volume as well coming in from the earlier sessions, 10 a.m., 11 a.m., nice build up. I think the 11 a.m. spread was really good versus volume. And then we started to pile it in. I think at this point, it was definitely a case for long. And obviously, you can already see that there was a lot of demand at this stage. And this was kind of, in many ways, a bit of a shakeout. Right, so again, we start to quantify this. Again, when you look at my Wyckoff course, it really tells you about terminal shakeouts and that spring, so trading off the spring, basically. So there's a lot you can bring to the table. Now, just so you guys remember that VSA, which is what it was called in the old days, is a brainchild of Richard Wyckoff, right? So Richard Wyckoff was probably the first guy that started to look at volume spread analysis. And that obviously passed on to Jesse Livermore. And then it passed on to modern day practitioners, right? So at the end of the day, right, VSA is coming and it's best used in a Wyckoff environment, right? So just, you guys, but again, if you're using volume price analysis naked, this is the kind of stuff you should be looking at. You're looking at volume reaction in real time. All right, good. So hopefully we get that concept of using a practical aspect, and we're talking about crude oil here, and we're using tick contracts, and we're not actually using the actual futures contracts. Again, if we had a window into that, it would be awesome stuff. And guys who actually looked at my TPO course, by the way, so my time price opportunity course, again, if you're combining volume price analysis with time price opportunity and that statistical element, you get an even more poignant effect when you're making that analysis, because then you know that, for example, if you're gonna be long in the value area, right, you get a lot of volume pile in, right, and so you get a nice little move like this and it's approaching a value area, then you know that you can buy the market safely for value high, and you probably got your value trade there. So it's just these little things that you can combine, and they really make a difference to your trading, guys. Trust me, it will be phenomenal. Like, I've had so many people who've been trading helter skelter come back to me and say, Awesome stuff, Dan. This has been like a real transformation. A lot of guys would attest to that. But anyway, and going forward, just bear that in mind, obviously, when you're dealing with volume price analysis. So some really cool ideas here that I hope you've enjoyed. Right, in the next practical application, we're going to look at a completely different asset. Probably look at something on the currency fence, and we're going to look at how we apply volume price analysis in that context too. Alright, hi guys. So welcome to this final section of the course, which is going to be looking at long-term trading strategy when applying volume price analysis. Now, one of the really cool things that I like about volume price analysis is that you can apply it on every time frame. And if you're on a longer time frame, yes, you have to think about your risk in a more longer term. And I'm not going to discuss risk because I always say to traders that, look, if you can't afford to trade a market, don't trade it. And you would hear a lot of large traders say this, that if you can't afford to trade a market, don't trade it. If you're trading a market and you're worrying all the time about your risk on the table, I'm not saying don't worry about risk, but if you're worrying all the time that you're over leveraged, right? So you need to start really defining stop losses quite heavily, then you're in trouble already. And you're probably going to lose a lot more money investing in the markets. And just so you know, so there has to be a certain degree for tolerance for risk within reasonable parameters, right? And of course, at some point down the line, I'm probably going to do another course which is all geared towards risk. But for now, keeping it very simple, I'm not going to touch too much on risk, right? So for guys who haven't seen me talk a lot more about where my stop loss is going to go in that scenario, etc., I've avoided the subject altogether because I think it is not really a thing, right? If you should trade a reasonable enough size to be able to handle a reasonable amount of drawdown. It was, I think it was Warren Buffett, right? I can't remember, but I think it is Warren Buffett who said that if you can't handle a 25 to 50% drawdown in the equity markets, you shouldn't be trading stocks, right? That was his conclusion. And if you're thinking about other markets like currency over a longer time frame, then you have to be prepared to handle a reasonable amount of drawdown across your entire account. And that's just me being reasonable with you. Right, so going forward, guys, I'm not touching on that subject hugely because I want everyone to focus on the idea and how to initially construct their VSA strategy, and then they can move on to see what's the best risk strategy to apply to this newfound idea, right? And maybe it doesn't work for them at all, right? So this is just something that I want to kind of touch on. Right, so one of my favorite assets is gold. Right, I love gold, and I love gold because there's still a sufficient amount of volatility on gold, even though there's an argument that it's all cooked up these days, and you know the U.S. is suppressing gold. I mean, which is the Russian and Chinese argument that the U.S. is suppressing gold, and it's it's undervalued and it should be higher. And I totally agree with all those narratives, but it's still a great asset to trade. Right, so I do actually like gold. So going forward, we're going to look at longer term strategy. Right, so we're going to use gold as an example where you tend to see a lot more even volume. Gold is heavily traded day to day to day, so changes in volume are not something you see all the time. So this puts us very much in the field of dealing with our VSA more from looking at it from a volume spread analysis point of view rather than a volume price analysis point of view. But we're going to incorporate both. All right, so one of the things I look out for when I'm trading gold, especially on a longer term strategy, is on one side of the fence I'll have my TPO chart, which is great for giving me statistical boundaries and identifying those breakouts. And I also have my volume analysis, which I'm going to run through you now. So some of the times the key things is we're looking for extremities. And remember, guys, where those extremities occur are pretty crucial. So one of the longer term trading strategies I try and employ is I look at the volume bracket, okay? And what I'm looking for, so let's take, for example, I'm looking for volume that is unusual, right? So and you're going to notice something very quickly when we start dealing with stuff like gold. So what I'm looking for at this stage is that I'm going to use my very interesting tool, which is the replay tool, right? And to kind of illustrate that. So that helps us get rid of a lot of chart, okay? So now at this point, let's hit the play button, right? So we can see that. Okay, so usually this will be our first window. So at the end of the day, you look to the market and it looks like this. Strong volume, right? And we look at strong price. Now, one of the things I'd actually like to do is I'll normally go back historically and kind of map, has there been any other volume brackets that have been noted important, right? So, and one of them is this one here, which is actually quite, oops, didn't want to do that. So that's one of them, is this one quite here, which is actually quite climatic. So we've got a very tight spread, high tail, and it's implying that this market wanted to sell off, right? But we're not going to rush into this. So this is a long-term trading idea. So again, we want to make sure that we're factoring in the risk on every trade, right? And when I say risk, I'm not talking about stop losses here, the risk that something may not go your way, right? So let's have a look. So let's narrow that spot out there. So we can see that this bracket here was a high volume node, right? Could be that this market is going to sell off. This is a climax, okay? So we've got to keep an eye on that. Now, historically, it did sell off. We actually came churning through that high volume bracket, breaking it on the low sides, and it's a complete bloodbath. Now we're showing volume again, right, on this side of the fence. Now, I would assume at this stage that this is strength, right? So this is a market that I will be reasonably looking to buy. However, I want to make sure that we break those highs in subsequent markets. So I'm not going to buy it just yet, right? Now, gold is very volatile, so I don't necessarily have to worry about people coming around the other side to kind of crush me out. Right, so as we settle into this position, my next thing will be to see what happens next. Remember, guys, I'm only going to trade long, right, just put an arrow here, above this price level, right? So my long trade is going to come when I get a solid close above that price level. So that's 1259.96. So I'm going to hold fire, right? I'm not going to do anything, right? So I'm not going to also have a bias, okay? I'm going to be looking at solid lows if we close under this sort of position, right? So I'll be looking at short if we're under 1234. So it's pretty simple at this stage, right? So now I'm going to open this up again, and oh look, it's not broken yet. So we're still playing within that bracket. Amazing, right? And then all of a sudden, so let's just hit a pause, right? We break it, right? So my trading opportunity is now sitting between here and here, and I'm at least looking that I'm going to get the highs. That's 1296. Well, that's like about over 30 points. So it's a really great trading opportunity. So I'm not looking for much. I'm just looking for a revisit of the highs. But however, this could be a potentially really strong long-term play. Now, one of the things that's happened at this stage is that we've also shown a huge amount of volume on the supply side, very high volume, very narrow spread, and we're like cut off at the bottom. So it's literally a legs chopped off right there. So at this point, this is also a very interesting bracket to me. So to kind of really give me a good window, I'm going to lock this in again, right? Just so I know that that's the level, right? Again, this will be a big warning sign if we start to break that as well and retest the underside. But I want to see it close. So now I've got my close here, so I should reasonably look at a long position, right? So I assume that a lot of strength is creeping in the market right now. So let's see what happens. Okay, so it rises. Great. So it's good news. And we're already where I wanted to be from a target point of view. And a lot of traders thought like me. So as we approach those highs, 1293, obviously we did get 1296. As we approach those highs, the market started to sell off almost immediately. And you can see that additional supply there, rise in volume. Spreads are getting a little bit restricted as we go, but it's a pretty decent one. So let's see what happens going forward next. Right, so we're still guided by this very high volume. And then let's just take a pause there for a second. So we can see again that we got a lot of tail and a lot of supply, and we're breaking that level. So if we're already out of our position, which we should be, we're going to look to short, right? So I'm just going to put that down here, right? So sell. I'm looking to sell at this point. That's a very good bracket here. So I've created another bracket for myself. We're under it. I'm looking to sell. Now, I'm also aware there's a bit of problem at this stage because we've had a lot of volume trading. So I'm going to look to exit. Whoops, flip this around. So I'm going to look to exit at those lows there, right? So just draw that line here. So that's kind of why, because this is my support. This is really solid support. This will put us into a much more long-term decline. So I'm actually more conscious of this, and I'm willing at this point to kind of exit the stage. Right, so let's see what happens next. Right, so we keep dropping, boom, boom, boom. That's looking good. And oh, we're taking in some strength at this point. So yeah, but we're still looking good. So we're taking in some strength, and I'm getting a bit concerned now. But obviously, we're still on the low side, and boom, we crash it in the end. All right, good. So again, you can see that when we had that climax here, it was on really low volume relative. So I'm not really concerned that buyers were heavily invested. These were probably weak buyers, and really what I was looking for was that level. And as you can see, most traders thought like I did, they pushed out at 12.35, and so we created a bit of a tail. Eventually we broke down and we retested those lows, and like I said to you, it'd be a more long-term effect. But if we look at the supply side of the notion, so we had a really tight spread here, very high volume, definitely an anomaly, and then we started to break that anomaly and take out those stops. But the volume is starting to decrease. It's looking a lot lower as we go. I'm expecting buyers to soon get invested. But again, remember the levels that were of interest to me are these primary levels. So this is my baseline, guys. So that's how we start to create baselines. Right, so if I just put a little horizontal line here, so that's my baseline. So I want to trade all volume that can trade around that baseline. Now if you use an MT4, a lot easier to create baselines. TradingView is much more dynamic on the chart, so it's not as easy to create a baseline on your chart. But what you can always do is record the contract amount. So 412 was good, nice little move there. 507, 388, 485. So these are the extremes for this point in time. Okay, these may go up in future or may go down. So we have to maybe review our baselines every 3 or 4 months to make sure that they're holding up. All right, so again, we can see that all our volume now is trading relatively average. So there's nothing of real note or concern to me at this point in time as we break down. Let's see if we start showing any degree of strength. And no, not really. Markets are relatively stable and so on. Okay, so again, so let's just pause that for a second. We can see, oops, that was it. So we can see as we sort of ended here, we can see a bit of difference now. So we can see a bit of a volume spike here, very narrow spread, and then we beat that and broke higher. And then again, we're showing a lot more excessive volume now, trading at these sort of levels, right? Again, and then we beat that and broke higher. So now the market is a little bit exhausted, right? Because we didn't jump in straight away. We're looking for much more of those higher volume spreads. So we're going to sort of surpass this opportunity because we know the sellers are still quite invested. Now, if we combine our total analysis and say, well, what's the volume doing with this price fall? Well, it was declining, right? So that was probably a warning sign that strength would return. So once we started to see equal volume now, so if I just take a line, and let's just hit that in trend, so we can see that from the big supply end we were dropping, and right at this point we show a bit more peak in our volume. So that's a lot more buyer strength, right? And you got to be asking yourself, why are we seeing this? Could be early strength, and this is how the smart money get involved. They get involved very quietly. So I'm just trying to find a market here to denote that. So they get involved very quietly at that point there. So that could have been a point where we could have zoned it and say, look, I'm going to trade this long on a break, right? But like I said, you're not going to see everything, guys. So don't beat yourself up about right or wrong. We're just trying to play here from an experimental point of view, right? So again, we could have looked at a long, right? So if we were going to look at a long, we would have looked at a long up until this point, right? Back into the pressure area, right? So you should be really getting out now, but we're a little bit late, and that's the reason I wouldn't go long yet. I'll look for a retracement. So let's see how things keep playing out, right? So the market starts to play around. So now we're within this sort of volume bracket, so we're probably going to take it out of the highs, but I would like to see a bit more intent relatively. There we go. So we get it, right? So that's it, right? So at this point now I can see that there may be some continuation, slightly higher risk on the trade, so I may dial down my size. Okay, I might say, okay, this is gonna be a bit of a punt, right? So we've got a nice VSA spread here, nice volume spread, nice price spread, and we're trading within a very strong volume area. We shouldn't be seeing this. The sellers should have responded a little bit stronger, right? So, and we're just after retracement, right? So this was the seller's best answer to the whole situation, right? So it's also not a bad place. So again, on a break of that, right? So we're looking at a somewhat solid close at the top. I think we should be a little bit more keen to get on the long side. Again, now we're almost at the top of the market, so it was probably a better idea to start at the bottom, but I think that we're going to get more upside. So again, as we push, let's see what happens. There we go. So it's good sustenance, but all of a sudden we're seeing a bit of a problem here. So again, whoops, right at this point, we need to see this level go, right? So at this stage, remember, we got long a little bit late, and that's the problem you get when you're long a little bit late. What you're then looking for is, will this level hold up, right? So we're seeing a lot of volume coming in now. So this is typical of a market that is under a lot of pressure and may well sort of push lower. So it's in a lot of climaxing happening, right? It's a bit of concern. So at this point in time, if you were long, you'd want to get out. If you're late long, you'd want to reconsider, right? But anyway, we break, and at this point, I would probably be looking to get out, right? So I'll be saying to myself, you know what, call a spade a spade. Now, we did go a little bit higher, but again, like I said, it would have been a good trade to sort of jump out at this point. Now, just pause that for a second. It's a low volume climax. Actually, what am I saying? It's a high volume climax. So at this stage, I know that anything above the market is probably relatively overcooked. So I won't be taking any more longs. It's been a long extension. And if I missed out on this trade and I got involved a little bit later in the day, because I had to wait a lot, which was about here, to be honest, between here and here, then obviously this should be the last one, and then we're probably going to start breaking down. So at this point, the market is overcooked. Anyone buying here is going to have a lot of trouble controlling that position, right? So again, if we just look at the top side, so we get that final TSO situation. So again, it's like a terminal shakeout, but we call that, in Wyckoff, we'll call that an up thrust. So I'm getting that up thrust there, and that tells me that this market is probably done and dusted. So again, a solid break underneath. I think by the lows of the prior day, I'll be happy to execute a dynamic short that we're not going to get picked up. But again, if you're a bit late, you'd probably want to be shorting from about here, 13.26. I mean, you're already 13.10, so it's looking pretty good. And again, as we drop down, I will always be looking for the next bracket. So just put that in. So if I was short here, I'll be looking to sort of get out within this zone. I think this would be normally a really good drop. So anywhere within here would have been good. So the 1300 handle, a little bit under, and I should expect traders to start leaving the table now. Right, but no, they don't. It still keeps going lower. So it's a pretty good decline. Again, I would have exited here, and but you can see that volume falling off now. And oops, there you go. So that's the buyer's answer to that question right there. So you can see that volume drop right out on the way down. So this helps your timing to get out of trades. The amount of time that people have told me that they were late to get out of a trade. So this understanding of VSA helps you as well, and volume price analysis helps you to kind of get that feel. So look at how we go down on that volume price analysis. Just look at that slope there telling us that there's a problem, and just look at those buyers stepping in at this point, right? So again, you know, we could have been quite keen to zone this off. Slightly lower volume though, but it's that initial strength that we tend to see when the smart money is about to get involved. And it's a good zone as well, then I would want to sort of get involved. And look at us break above, right? And then we can see that the market is getting a little bit restricted at this point. So this will be a cause for concern for me. And then I'll have to reassess. But again, that tells me now I can measure to see. Just measure to see if this is real strength, right? So I know my VSA is telling me that there's a bit of a pushback at this stage, right? And if I was long already, I'm thinking, so maybe I was long on this day, I've got my guard up, so I'm looking at maybe 13. Let's see the reaction at 13.12, right? Could be a bit of a retracement coming at the highs. Yeah, so I'm always watching those brackets and see if volume's going to back it, right? So I've got my finger on the trigger, right? And I'm waiting, right? So again, as you can see, we're pushing higher and away we go. Oops, sellers have responded. So again, just being cautious of the fact that that could be a retracement, and just obviously look at how the market keeps playing out. So these little things here, they kind of keep you in check. But then as we go down, you can start assessing that strength and weakness as you go. So judging from what's taking place here, I'm guessing that it's a bit of a struggle at this point in time, but buyers have definitely come in to kind of try and check the supply side. So again, you know, you can see that, whoops, there we go. So you see that other bit of strength there developing. So it's a little bit more of a struggle now, and you know, there's a real fight taking place, but volume is dissipating all the while. So we're complexing out, and you know, we're getting to that point. So again, look at that supply, whoops, and there you go. So you can see, so again, another major response here from the buyer. So now I would want to short again, right? So if I was here, been holding out for a little while. At this point, I'd probably be saying to myself that I want to short. It looks like a good opportunity to sell. I'm within this volume bracket. I'm really churning, and let's see what happens. So again, and there we go. So we go down, right? So, and we should be looking at this stage. So just put a pause on that. So we should be looking at this stage for potentially. Now, it's for me, it feels volume is really dissipating. It feels a little bit late in the day. But if I was short in here, I'll be probably looking for the top of this. So I'd really want to see us into about 1220s. So let's see what happens if that actually takes place. So we can see that obviously volume's falling off, but again the market's sort of pushing away and it's sort of rejecting those lows. So it's a really interesting pull because again we see that all this buy side we don't get a lot of activity, and then all of a sudden, right, so right at the top here, right, so this whole time the volume just saps away on the price rise, so it catches you out a little bit. So even though we were a little bit right on the downside, but we just didn't make it to our target. So I would probably have been a little bit more aware as it cut back against me to probably exit the stage. But again, you know, right here you can see that right at the top of the market, we're pushing in a pretty big break. Now this is a really extended market, so these are the kind of longs that I really don't like to take. I need to see a pretty decent retracement because again there might not be a lot there. But that being said, you guys, as we touch in, yeah, so you can see now that we're getting a bit exhausted. So at this stage, yeah, I'm not, but there we go. So we're pushing up still, granted, but this is definitely a climax, and for me anything else is an up thrust. And if I just zone this, what took place here, right, it's a big selling move, I'll definitely be on the short side, right? So again, what am I looking for is a more long-term play, and this is probably the final play we're going to do. I suppose it will be a more long-term play, so right under that bracket, so right at this point where we get the close, I'm looking to push this into 1307, judging by it, maybe a little lower, but I think 1307, because I didn't like the behavior of those guys there. And let's just see how things play out. Yeah, and there we go. So we keep pushing away, and that's exactly what I'll be looking to get up. And again, obviously, tables turn, but for me, I'm not wide at this point. I'm fairly confident that this is a supply. Again, if you look at my Wyckoff setup, this is a supply area. So now all I'm looking to do is to see a break. I'm not seeing that. We're spending too long here. I need to see a break now. It's becoming a thing of urgency. So at this point in time, we're retesting these lows. So if you're not already out of the market, I think you should be thinking about getting out. So you can see the buyers trying to sap things back, and that's always a cause for concern going forward, because we might just break out and test the highs one more time. But again, that's how you play with volume price analysis, right? But definitely looks like a supply setup. So again, we're looking at these highs obviously to get taken out. Doesn't look that way, to be honest. And yeah, so that's it basically. So this is what we're now modern times, 1327. So obviously gold is weakening out. We're seeing a lot of climaxing happening, and it's getting really difficult to gauge. But again, we'll see how the coming days result. But definitely for me, this is a typical supply distributional setup. Maybe in the long term, we end up declining. But also, very good chance, judging from the asset behavior, that we could retest some highs. But again, does look very much like a distribution setup. So hopefully this has been a really useful session using gold. I mean, we've had lots of short-term opportunities we could have played with, and even at points when it gets really messy. Again, if we're very good at assessing those breaks, we would have had a few things wrong, and we'd have a few things right. But all in all, we should have been sitting pretty. All right, any questions, guys, let me know. This is, again, a good way to long-term approach trading with volume price analysis. And if you combine that with Wyckoff or time price opportunity, you have an awesome recipe. I think for me, this is what was missing in some of the coursework that I've done on Udemy. And this has obviously come to sort of fill that gap. Well, have fun, guys. And any questions, let me know. And leave a good review for the course. I mean, anything you think we could have done better, send me an email. Let us know. We're always there to take that on board. Don't be in a hurry to sort of give us neg. Right? Obviously, we're trying to make this really good for you guys. So in the end, just let us know, and then we'll try and improve on that a little bit better. We're just trying to share our knowledge that we've taken through the years, and trying to make good of it. So any questions, guys, just let me know. And I'm always humble for your questions. Have fun, and thanks for watching. Really appreciate it.